Later this morning, the markets will contend with economic data on housing and consumer sentiment. That's on the heels of inflation and retail sales reports already this week. For more on the economy and what the recent data could mean for the Fed and for rates, let's bring in Dana Peterson, chief economist at the Conference Board. Dana, we were on the verge of the apocalypse, and now I guess the sun is shining and it's not happening again. What was your read on the panic of, was it just last week, guys, that we had that panic? Was it last week?
Yeah.
And now where we're at after a decent retail sales report and jobless claims not spiking.
Sure, I always thought the panic was overwrought. We had many different factors all converging at once that were quite really unrelated, and we didn't have strong data suggesting that the U.S. was going into recession or that the employment market was going to collapse. So I still think the same things now, that the economy, yes, it's slowing, but it's still pretty healthy. And certainly with retail sales coming in as strong as they did, consumers are still interested in buying goods and going to bars and restaurants.
What's your estimate? I guess it was Alberto Musalam from St. Louis yesterday putting the recession chance around 25%, which is sort of in line with what we've heard from different Wall Street forecasters. What's your probability of recession, and what are the things that worry you?
Well, I think it's probably under 25%. You need to add some percentage there's always some likelihood of probability of recession. But I think that the things that I'm really worried about are mainly external to the U.S. economy, certainly geopolitical issues that might cause a spike in food or energy prices, also things that, policymakers can't control, like natural disasters, hurricanes. We had another hurricane last week. It may impact the labor market data. So those are the things I'm really worried about. I'm not terribly worried about the consumer. The consumer certainly is pulling back on their spending. And even if their spending went to zero, many of them are still working, and many of them are seeing wages that are elevated. And so that's still income coming in. Meanwhile, inflation has come off. Yes, prices are high, but it's not the case that prices are rising as quickly as they were. So that's giving the consumer some relief.
Dina, are there structural factors out there that make you, pessimistic or concerned that the Fed can't get back to the 2% inflation target?
Absolutely. One big structural factor is the fact that baby boomers are retiring. 10,000 a day roughly. And that means that we still have labor shortages. They're not going away. They may have eased somewhat, but if you look at the JOLTS data, you still have an outsized number of job openings. And when you dig down into the industries, it's those sectors that are hiring the most in payroll. So it's healthcare and social services, leisure and hospitality, government, construction. Many of these jobs you have to physically show up to work for. So any frontline and manual labor jobs are going to continue to see labor shortages, and that's going to put upward pressure on wages, which we're seeing. The other thing is insurance costs. I don't know when they're going to stop rising. They've slowed in terms of the rate of appreciation,
right,
but certainly we're seeing insurance costs rise. The Fed can't control those things.
Dan, I want to get to the Fed in just a second, but tell me what your data says, and I know you come out with this every month, about people's security in their jobs. Do people still feel as confident as they did before, that if they lose their job, they can get another job, or as confident as they did before that they're not going to lose their job?
Yes, that's a labor market differential. Most people still say that getting a job is easier than not. However, I would say that differential has shrunken. It's still positive, but it's not as big as it was. So there is some concern presently about jobs, but it's not that significant. And even when we look out forward, for the expectations measure, consumers have been saying the same thing. They have some underlying concerns about the job market, but for the most part, they're working and they're fine.
All right, let's put all that together now. What's your expectation for Fed policy? September, 25 or 50, and then moving along during the year? How much in the way of rate cuts, or not at all, do you expect?
We do anticipate the Fed will cut interest rates by 25 basis points starting in September, and then 25 basis points in each November and December. Here's why. The U.S. economy is
Dan,
still...
I'm going to interrupt you and just tell you you're a
sure.
little bit below. Guys, if you put that chart back up, I just want to explain that chart. We've gone to a different way of showing this. So that's minus 25 is the market pricing, and the futures market pricing for September, bringing it down to 513, and then another 25 in November, which is in line with what Dana just said. But the market pricing in a 50 for December, which is 437, would mean a whole 100 basis points through there. So Dana's just a little bit light on that. Dana, sorry to interrupt. I just wanted people explain the new charts that we're putting up here on the Fed funds outlook.
Absolutely. And I think that the market is anticipating that we're going to have very, very weak growth in the fourth quarter. We basically have GDP growth kind of bottoming in the third quarter and then picking up slightly in the fourth quarter, but it's still going to be weak. But I think that the fact that the Fed is getting a head start on cutting interest rates starting in September, that's going to have a psychological effect. Already we're seeing mortgage rates fall, and consumers will feel, even though rates won't be terribly different, they'll feel like they're going to get a break. And so that may help the economy grow slightly faster in the fourth quarter. We'll see, but still, we think that the Fed can go very gradually, especially if inflation doesn't fall as much as they expect.
I'll just add one thing, Dana, and I want your comment on this. I think this is a potentially dangerous time for the economy. I think this moment of transition to lower rates, if I'm the CFO of a company, and I'm ready to go do a share issue or, most importantly, some kind of bond issue and raise money, I might wait. I don't want to do an issue right now at 4 when it might be 3.5 a little down the road.
If you're a homeowner who wants to do a renovation, you would put off the bathroom
You
remodel
might put
because
it
you think
off.
you're going to get financing costs lower.
Exactly. Dana, is there any evidence that this transition period is one that should cause excess concern out there?
Well, the truth of the matter is that businesses have been putting off those big investments because the cost of capital has been high. And the same thing with homeowners, potential home buyers. And even homeowners are not interested in selling because mortgage rates. Yes. And so the thing is that this is already happening. It could potentially accelerate, but we've already seen this action. And I think that the psychological effect of mortgage rates coming off may be helpful. Certainly, if you're a business, you still can sit and wait because, a 25 basis point cut in interest rates is not really going to help you. So that's why we think the economy will probably pick up more so in the second half of next year. But again, the psychological effects are important.